Hello everyone. In this video, I will introduce what is cash flow to creditors and cash flow to shareholders. So once the company generates cash flows by using those assets, they will have to pay those cash flows to either creditors or shareholders. So the cash flow from assets should equal to the cash flow to creditors plus the cash flow to shareholders. So cash flow to creditors definition is interest paid minus net new borrowing. And this balance sheet means B/S means the data from balance sheet. I/S means the data from income statement. So basically means when we do the calculation, we need both balance sheet and income statement. So the net new borrowing is ending long-term debt minus beginning long-term debt. So the long-term debt, 2000, basically how could we calculate the net new borrowing for this OZ firm? So it's long-term debt minus long-term debt for 2007 minus long-term debt for 2006. So the data is here, and then you will find that the net new borrowing is 46 in millions. Here you should know every number, all the numbers are in millions. So the cash flow to creditors equals to interest paid, which is 70 millions minus the new borrowing. So it's 24 million. Cash flow to shareholders is also the information should come from both balance sheet and income statement. Equals to dividend paid minus net new equity raised. So here you should, one thing I want to know, the interest paid is a cash outflow for the firm, but the cash inflow for the debt holders. So the net new borrowing is a cash outflow for the debt holders. So those are net cash inflows from the debt holders' perspective. And the same stuff, the same theory applies to stockholders. The dividend paid is a cash flow for the firm, but it's a cash inflow for the shareholders. The net new equity raised is a cash outflow for the shareholders. So the net new equity raised equals to the ending net common stock plus ending paid in surplus minus the beginning common stock plus the beginning paid in surplus. Paid in surplus is first issued stock sales at a premium, repurchase of stocks and resold at a higher price, and the donated stocks, those are in paid in surplus account. So for OZ firm, net new equity raised. So the ordinary shares, that's the common stock, and we do not see the paid in surplus account. So it means it doesn't have any paid in surplus. So the net new equity raised is $40, and the dividend paid is $103 millions in millions. We will find that the dividend paid minus net new equity raised is 63 millions. That's the cash flow to stockholders or shareholders. So here's one more practice. The following is a balance sheet and income statement for Form Z, and find out the cash flow from assets. So remember the cash flow from assets, the definition is operating cash flow minus net capital spending minus changes in net working capital. So step one, find out the operating cash flows. Operating cash flow is the earnings before interest and taxes plus depreciation and minus taxes. All the information from income statement. So we found out that The operating cash flow is $470 in millions. The second step, calculate the net capital spending, which is the ending net fixed assets minus beginning net fixed assets plus depreciation. It's $10. And the third step is calculating the changes in net working capital. So it's net working capital in 1998 minus the net working capital in 1997. Remember, net working capital is current assets minus current liability. And then we found that the changes in net working capital is $80. So we found out the cash flow from assets is $380 million. The second one, calculate cash flows to creditors equals to interest paid minus net new borrowing. Remember, the net new borrowing is ending balance of long-term debt minus beginning balance of long-term debt. So those are, remember, this is the ending balance. This is the ending balance. This is the beginning balance. Because the ending balance is 1998, beginning balance is 1997. So the long-term debt, the net new borrowing is negative 139. The interest paid is 50. So the cash flow to creditor is 189. The cash flow to shareholders, net new equity raised is end common stock plus end paid-in surplus minus begin common stock minus begin paid-in surplus. So this paid-in surplus here is also called capital surplus. So then we found the net new equity raised is $10. Dividend is 201. So we find out the cash flow to shareholders is 191. So then we found that the cash flow from assets, which is 380, equals to cash flow to creditors plus cash flow to shareholders. Here is one practice. So we have this balance sheet and all the information for income statement are here. The cash flow from assets, first we need to find out the operating cash flow equals to EBIT, which is here, add back depreciation minus tax. It's 2,000. Net capital spending is ending balance net fixed assets minus beginning balance net fixed assets and add depreciation. Here, this is 2002 year. Those are year 2002 and year 2001. And the changes in net working capital. So the ending balance of net working capital is 2,000 minus 1,700 is 300. And the beginning balance of net working capital is 1,500 and minus 1,300. So it's 200. So the changes is 100. So the cash flow from assets, according to the formula, is 600. The cash flow to creditor is interest paid. The interest expenses is here, minus net new borrowing. Net new borrowing is ending balance minus beginning balance of the long-term debt is 600. So the cash flow to creditor is negative 400. Cash flow to shareholders, so we need to find out net new equity raised. It's the ending common stock minus beginning balance of common stock. It's 250. And dividend paid is 1,250. So we found out the cash flow to shareholder is 1,000. We found out the cash flow from assets, which is 600, equals to 1,000 minus 400. So the cash flow identity holds. And the next practice is also ask you to find out the cash flow from assets, cash flow to creditors, cash flow to shareholders, and verify the cash flow identity. So first, we of course need to find out the cash flow from assets. Cash flow from assets again equals to operating cash flow minus net capital spending minus changes in net working capital. So we need to find out the operating cash flow first. It equals to EBIT, add back depreciation minus tax. EBIT is given here. Add depreciation minus tax. So it's 2,650. Net capital spending is ending balance fixed assets. This is ending balance minus beginning balance fixed assets, and then add the depreciation. So it's 1,350. Changes in net working capital is here. Net working capital again equals to current assets minus current liability. The changes in net working capital is 100. Then we found that the cash flow from assets is 1,200. Then cash flow to creditor, we need to find out the net new borrowing equals to ending long-term debt minus the beginning long-term debt. It's 600. Cash flow to creditors is the interest minus the net new borrowing, so it's negative 100. Cash flow to shareholders is equal to ending balance common stock minus beginning balance common stock. It's 250. We do not have paid in surplus account. And the dividend is 1,550. So we found out the cash flow to shareholders is 1,300. And we found out the cash flow identity holds. There's one more practice. Basically, it's similar. We found out the operating cash flow equals to EBIT, add back depreciation, and then minus tax. So it's 2,650. Net capital spending is ending balance of the net fixed assets minus beginning balance of the fixed assets. Add back depreciation, it's 2,100. Changes in net working capital is over here. Net working capital is current assets minus current liability. The changes is negative 950. So cash flow from assets equals to operating cash flow minus net capital spending minus changes in net working capital. This minus a negative number is a positive number. It's 1,500. Cash flow to creditor is interest minus net new borrowing. And the net new borrowing is the difference between two long-term debt numbers. It's 300. And the interest paid is 500. So the cash flow to creditor is 200. Cash flow to shareholders, we need to calculate the net new equity raised. The ending balance of a common equity minus the beginning balance one. There's no paid in surplus account here. So it's 250. And the dividend paid is 1,550. So the cash flow to shareholders is 1,300. Again, we found the cash flow identity holds. So here's one more practice. Plaza Cafe has an operating cash flow, depreciation, tax, and it gives you some numbers of its balance sheet. And then operating cash flow, it gives you. Operating cash flow is over here. And the net capital spending is the ending balance of the net fixed assets minus beginning balance of the net fixed assets, and add depreciation. Depreciation is here. So we found the net capital spending. Changes in net working capital is determined by the current assets and the current liability. So this is a negative number, which means we sell some current assets like inventory and free up some cash. So cash flow from assets is 47,949. That is the cash flow from assets and cash flow to shareholders, cash flow to creditors. Thank you for watching, and that's all for chapter 9.